Oh, I think we're live again. Hello, everyone. It is Rob Keenes, your host of the 𝙎𝙊𝙇𝙀 channel here on YouTube. It is now just about 5:45 p.m. on Tuesday, August 23rd, 2022. Going to do my customary sound check to make sure YouTube is, all the technology is working. Oh, looks good. We've got sound. A lot of you guys are in. Thank you so much for joining. This is Cowboy Metals live stream, where we broadcast from the great state of Texas. And we take no bullshit because that's who we are. We're not going to feed you a lot of garbage. Our role is not to get you to buy something that you don't want. Our role is to educate you so that you have the information you need to navigate this financial period of your life and to become better investors and to reach whatever dreams it is that you want to reach. So with that being said, today the title of the presentation is "This Gold and Silver Trade Will Break Records." Well, what the heck could that be? Well, I'm going to tell you here in just a moment. It's a hint for you. It's going to have to do gold, silver, and real estate. Why am I doing that? I'll tell you that here in just a moment. Now, we do have a poll up. The poll question is, do we hold gold and silver forever, or do we eventually rotate into new assets? And this is really a piggyback from a presentation that James Anderson of SD Bullion made on our last conference, I want to say back a couple of months ago, when he talked about exit strategies for gold and silver. And he has this really great presentation on all these factors and when you should get out of gold and silver, because as he says, and as many people say, everything eventually becomes a bubble. Gold and silver are not there yet, we don't think, but eventually they will be. And the question is, what the hell do you do when they're in a bubble? What do you go into? Well, we're going to look at real estate, but I also want to look at how bad that real estate crash was back in the 20s and well, after the 20s and the 30s, and compare it to current period. So because why? The main reason is, if you're not going to invest in real estate and you're not going to rotate assets, you probably still own a home, most of you. And that is the major wealth building vehicle historically in the United States. There have been more investors and people that have become millionaires from real estate than anything else. And so this is a really broad topic, I think, that's going to touch everybody. All of you either own your own homes, or you're a real estate investor, or you know somebody that does. So do we go gold, silver forever? Do we rotate when the bargains come, or don't invest too risky? Those are three different options for you in the poll. I think it covers most of the options that one would anticipate. And we're going to be off here in a moment. We've got 116 viewers. Remember, super chats are open if you want to support the channel and 100% get an answer to your question or comment. If you do the super chat, they'll grab my attention. Otherwise, I will do my best to see your question in the chat. Although with as many people as we typically have in, sometimes I miss some. Do my best there, but super chat it if you want an answer to your question. Remember, these are live streams, so we do Q&A throughout the presentation. I'll check back on the chat and see how you guys are doing, and definitely will answer the questions on the research that we have. And we do that to be accessible to you and also accountable to you in our research. We want you to question and turn over everything that we do to make sure that we're providing you the best. And as always, I learn from you as well. Another quick sound check and we'll get into the prezzo. I got sound. YouTube is working. We're ready to go, guys. So getting all the way over to Zoom. We're going to share screen. I'm going to do this in a couple of different ways. I've got a formal presentation I'm going to give you. But one of the things I like to do, ladies and gentlemen, is go back to what I used to talk about, what I've written about before, and see, was I right or was I wrong? So we're going to do this with real estate. And as you can see, I have an article loaded up on Seeking Alpha, where I used to write and be syndicated across various financial publications online, including Yahoo Finance, NASDAQ, Market Watch, Financial Sense, so on and so forth. So I used to write for them. That's what I used to do before I did video. I was an analyst. I liked writing. And I wrote an article back during sort of the height of the first year of COVID. And it was commercial real estate is coming under immense pressure due to COVID. And basically, I just took what's going on in commercial real estate, given the economic issues that we had, and I wrote a little article. And is really a video at the end of the day. But this article is what I'm going to focus on because it has some cool data points. Why did I do that? Because I'm a huge real estate investor. I got on 2018 probably a little bit too early, but I was sector rotating into precious metals and liquidity cash, thinking that there'd be another time to come back into real estate. And yes, I did leave some money on the table, but I'm perfectly fine with it because I think I'm a cycle investor. Rotating in and out of cycles every 10 to 15 years is what I do. And if I'm a little bit early out of a trade, that's okay, because the next one, I'm going to make plenty of money because I've identified it early. And that works better. History shows that people that sector rotate and don't trade on an everyday basis do much better than those that try to day trade or short-term trade. So that's what I advocate. And that's what this video is going to be about today. And I'll talk about gold a lot. I'm going to talk about a lot on gold. So don't worry. I'm going to talk about gold. I'm going to talk about stocks and real estate and compare. So those of you that say, Rob, this is a precious metals focused channel. Yes, I will get into gold and silver, but I want to talk about what happens to assets during times of stress. And primarily, I want to talk about real estate. So bullet points. This is what I was seeing back in 2020. Experts predict 25,000 stores will close. Well, we know that 80% of the mom and pop restaurants never reopened that closed. 80% of the ones that closed, they don't expect ever to reopen. So the restaurant industry got hit big time. Top brand closures, Simon Property suing Gap for $69 million in back rent. So back then, one of the arguments I was making in 2020 is all these real estate investment trusts, the REITs, which is the paper vehicle that people invest in when they don't want to get into active real estate investing. They just want to buy a tranche of stuff, get a return like a stock or a fund, and they, are exposed to real estate, but they're not going out and actually buying properties and managing them and all that kind of stuff. The REITs were coming under pressure in 2020. And I've done some research on REITs, although I'm not done with it. I'll come back to the channel to talk about that, and I'll do a better review of REITs. But today I'm really looking at active real estate. We discussed a lot of reasons why it was coming under pressure. Data on delinquencies from TREP shows that all areas of commercial real estate were being affected in 2020. Why do I talk about this? Because the point I was making in this video was we're going through a mini downturn in COVID. The next time we go through our next big business cycle downturn, it's going to be worse, but some of the same things are going to show up. So when I studied the 2020 crisis period in real estate, I looked at what was being affected. And for the most part, it was all areas of commercial real estate. So it doesn't matter if you invest in strip malls, or you invest in storage centers, or you invest in apartment complexes, or you invest in commercial property in New York. It doesn't really matter. All areas came under pressure. So you can expect it probably will during the next recession. And I'll get into a really deep report done by the Federal Reserve Bank of New York about the crash that we had in the 1930s. And that'll be really interesting. And there's one point I'm going to make about this is one thing affects the value of all assets more than any other. And it doesn't matter what asset it is, whether it's gold, silver, real estate, stocks, bonds, whatever you're getting into. And that number one thing is what you got to follow. And it just happens to be the thing we talk about most on the program. So, hey, we're prepared for what's going on. I want to play a real quick, in addition to doing that article on Seeking Alpha in 2020, I started earlier this year in June talking about real estate starting to roll over. Now it was early, and I actually talked about earlier than that too. I talked about a couple months before that where some of the numbers were decelerating, but not going backwards. They were just slowing down. But here's a video that I had on that that I want to share with you guys because I kind of called it earlier this year and it started happening more and more. And that's really going to be the thrust of the presentation. So without further ado, let's get into the data and I'll tell you what my thoughts are. And here we go. So here's the video I did back in June. That's affecting a lot of what's going on in the economy. Plus we got the macro. So I'm going to talk about the macro here for a second. We're going to talk about across the board, U.S. existing home sales tumbled to a 2-year low. The NAR warns worse to come. So they think it's going to get worse. I think it's the National Association of Realtors, if I'm correct. You can see the data is red here. It hasn't been good for any of 2022. The best, most recent time we had were in the 2020s. As the pandemic is really just kind of getting started. But it's interesting to see what's going on with existing home sales. Now, existing home sales across the U.S. are retracing. They're not doing very well. That means that probably people are going to rely on the existing home stock more. That could have an upward effect on home prices, but it could also show that people just can't afford housing in general. So we'll have to see what the overall housing numbers are when they come out in the next few months. Here's also an article by BizNow, as reported on Zero Hedge, talking about commercial real estate being on the brink. Now, I don't think that this has to do with apartments because I'll show you that in a minute, but other types of commercial real estate are down. Some of the REITs that allow you to invest in that real estate are down. So you can see the FTSE, any REIT, all REITs index has plunged more than 21%. That's looking broadly at the REIT index. Industrial REITs are down 27.7%. Mall owning REITs are down 37.7%. Office REITs, or real estate investment trust is what a real REIT is, has fallen 30% on average. Well-known names like Vornado are down 36% year to date. Prologis 31.5%. So a lot of the commercial real estate's really down. not doing well. And this is something I called probably 2 to 3 years ago. I saw this coming. I talked about it on Zero Hedge. I wrote articles about it. The people that wrote about the REITs thought I was nuts because I was way ahead of the game. But I said, all right, so I'm going to stop the video there. But the point I was making was I did call this a couple of years ago. I did say this is going to happen. Now people can say, well, if you call it years ahead of time and you're not calling the exact day, it's easy to call it because we always have business cycles. The point being, what I'm doing here is comparing different business cycles to let you know what's going to happen when they occur. Because whenever they occur, whether it's tomorrow or 5 years from now, you want to be prepared for that and ready to sector rotate into areas that are distressed. The obvious trade I'm going to make here is eventually when gold and silver bubble up, which they will, all assets bubble up, and gold and silver typically do this when we have tremendous stress in the system, especially when there's more than just a cyclical business correction, but it's more of like a deep recession or depression. Gold and silver will get too high. You're going to want to rotate out and capture that value and put it into something else. You could go cash. You could go buy just a bunch of fun stuff and go take vacations, or you could buy another asset if you still need money, which all of us will. And I'm advocating that it could be real estate, but let's get deeper into the real estate discussion. So back in this video, I was making the case that during 2020, these REITs, these investment vehicles into real estate that are more passive from passive investors in their brokerage accounts, suffered tremendous losses. And that was just not a cyclical downturn, but a downturn brought about by a pandemic in which the government, shut some businesses down, but it wasn't a full-blown recession. It was like a mini recession, perhaps. But you could see real estate was not doing well even in the mini recession. The question is, what is the biggest factor that will affect real estate prices? Because if you want to rotate in, you want to know what those factors are. So you know when you're at the bottom of the real estate cycle and you can rotate in from the top of precious metals or stocks or whatever you're in and go to real estate or other assets. Looking at the data now, this is last week's data, and I want to talk about some of the real estate values didn't come out so well last week. So right here at the top, last Monday, the Home Builders Index, the National Association of Home Builders, is down. Expected value 54. Last month's value 55. It's a 49. So the Home Builders Index, as a measure of home builder strength, is waning. Building permits are down from 1.7 to 1.67. Although that did exceed the expected value from economists, it was still lower than last month, meaning we're still decelerating. We're on the down ramp. We're not accelerating. We're not growing. We're slowly shrinking. In terms of building permits, same thing with house starts. 1.6 million last month, 1.52 million expected this month, the actual number 1.45. So we've underperformed last month and what economic experts predicted for this month. And I believe there is another one. Existing home sales were down 5.11 previous month, expected 4.81. We did hit expected, but again, it's still down 300,000 less. So the property market is decelerating. So right now we know we're in stress caused by macroeconomic factors that's affecting real estate. Is real estate cheap enough to sector rotate? No. Gold, silver hasn't reached its bubble. Real estate hasn't crashed to what it's eventually going to crash to. Now, how much is it going to crash? That's the subject of this video. Before we get into that, I want to get into the gold piece. For those of you wondering, why be in gold? Well, over the last 20 years, and this is a good chart from Kinesis, gold has outperformed most real estate, U.S. stocks, bonds, and cash. So in 2000, if you're, a millennial baby and you're investing, you would have done better going into gold than all these other assets. So gold has already outperformed most commercial real estate, stocks, bonds, and cash. Or I should say most real estate with the exception of certain types of commercial stocks, bonds, and cash. So already gold has been a good trade, but we don't think gold's in a bubble given macroeconomic factors. So we think gold's going to run more, and we think it's going to give you even more leverage if you get into another asset. Here's another one by commodity.com, and they're comparing whether gold holds its value more or the house does from 2011 to 19. And it just depends on the year. There were periods of time when gold underperformed. These are boom times for the housing market. But when we started having economic stress the last few years, gold has outperformed. I don't have the 2020 and 2021 data, but gold outperforms housing during times of market stress. We know that. So what's going to happen? Gold and silver will go up, real estate will come down, hence the thesis for the trade. I also want to put out there the Case-Shiller home price index versus CPI. Essentially, this is taking home prices and comparing it to the government's measure of inflation, which is the CPI. Home prices since 2000 have gone up 300%, while the official inflation is only 100%. So in other words, you could look at this and say 200% is a relative overvaluation of housing to inflation if you just take inflation, if you're controlling for inflation. Now, that may not take into account pent-up housing demand by immigration, increasing population, stuff like that. But price increases are often also a function of demand for other products, food, energy, so on. So even though we've had inflation in food, energy, and so on, it hasn't reached what housing prices have reached in the last 20 years. So we still think housing is in a bubble. Now, it's interesting to note, if you go back to this chart, gold's done better than housing, which is in a bubble, but most people agree that gold's not in a bubble. So is housing or gold do better in different periods? It may not be what you think. The last 20 years, if you just owned a home versus gold and silver did you better than did the housing. Not necessarily income producing property, but just in terms of your house prices. And a lot of people don't know that. Most people, their wealth is tied up in their houses, but gold and silver does just fine as well. I just wanted to point that out. We have here a good newsletter from Bill McBride, who does calculated risk. And I just want to show two charts. The first one is the Affordability Price Index. And a lot of my real estate investment groups were looking at affordability index. Why? If housing's not affordable, we may not want to invest in more. It may be time to pull back, right? You don't always invest in every sector every single time. You got to look at factors. So the affordability price index is certainly low when compared with previous periods, January 5, 06, you know, the inflation racked decade of the 70s and 80s. But we've had an uptick, and we've had an uptick since the pandemic. This is the pandemic demonstrated by this recession line. This is the recovery from the pandemic. As the economy has recovered, housing prices have moved up, demand's moved up. It just makes sense. But the affordability index is moving closer to unaffordable. It's not quite there yet, but it's getting there. Housing's just too darn affordable. This is a cool one. It's house prices to rent using the Case-Shiller index. The higher this number goes, the higher prices are to renting. Obviously, this number is going up, and it's almost at an all-time high, dating back to about 05, 06, not quite as bad, but we're reaching a point in which if you buy a house, it's less efficient in your cost for living in it than would be renting. So what's going to happen over the next few years? More people are going to sell their houses or not buy, and they're going to move to rentals. So what part of the market should do very well from a residential perspective over the next few years? It's going to be apartment complexes, those types of things more so than houses. And basically what that says is houses have to come down, apartment rents have to go up until they meet somewhere in the middle. Right now, housing prices in the monthly outlay that you have for that, for the same comparable property to an apartment, is more expensive. That's pushing people into apartments. That's part of the thesis. I think apartments are going to get more popular, and hence an area that I'm looking at to invest in. Here's a good chart from the Federal Reserve Bank of St. Louis done by Sunshine Profits. Just wanted to point out that when housing doesn't do as well, gold tends to do well. And when gold doesn't do as well, housing tends to do well. In other words, they're counter-cyclical. They're opposites. When you're doing a cycle trade, you're looking to get out of something that's overvalued into something that's undervalued. So a chart like this, which tells you that gold and housing are inversely correlated most of the time, especially during times of economic stress, that's what you want to know, because you want to move from an overvalued market to an undervalued one, and just keep doing that several times in your life, and you'll make more money than people who day trade every day. That's what the studies say. So let's look at gold versus Case-Shiller Home Price Index. Yeah, house prices have gone up 1,000%. Gold's in the 2,500% range. Gold has done better than housing. Of course, we knew that from the chart put out by Kinesis, but I wanted two confirming sources. People that watch this that are real estate investors that haven't followed my gold silver coverage are not going to believe that. They're not going to say that the average residential house price has been outperformed 2.5 times by gold since 2000, but it's true. And actually, if you go back to 1974, this has been true for about 50 years. So about 50 years, if you just simply held gold, you would have done better than owning your home. And we're not even talking about the expenses of maintaining the home, which are more expensive on a dollar per dollar basis than it is storing your gold. So houses were more expensive than gold for the last essentially 50 years, and especially the last 20 since the tech crisis. Now I want to get in the presentation, and I want to get into details about how real estate is going to react in the next recession. I think we're officially in the recession because we had 2 straight quarters of declining GDP or negative GDP growth. The White House is trying to redefine that, but in any case, whether they're in a recession or going into one, I think everybody agrees with that. So the Federal Reserve Bank of New York did this staff report back in like 2014, and it's really good. It compares the 30s housing crash, specifically commercial and commercial paper, to what we saw in 2008, 2009, and the effects after that. Which one was worse? Why do I do that? because the biggest argument I see in the markets about what to invest in is, between real estate, gold, and other things, is are we going to go into a light depression, a light recession, or a big one? And how do asset prices react during those times? How would gold, silver react? How would real estate react? How would other assets react? I've already talked about bonds extensively. I've already talked about stocks extensively. This time we're going to go into real estate, and we're going to compare that to gold and silver so that you guys have that data and that information. Because again, at the end of the day, I want you to do well in gold and silver, but I want you to do even better after, you know, it's time to sector rotate out of gold and silver. Let's check sound. Sounds good. All right, now we're getting the presentation. I've been in this for about 20 minutes. This is the good stuff. I gave you the background about what I'm doing. I gave you the background about the markets during times of recession, and I gave you indicators about assets during certain times. Now what we want to do is see how bad or how cheap could real estate get depending on the size of the crash, because is this something that we want to cycle rotate in? Do we want to go into stocks and bonds when we sell our metals? Do we want to go into real estate? I'm a big real estate guy, so I'm going to look at real estate today. All right, going back to the presentation. And this is also for the benefit of my friends that also do real estate investing, because, you know, I love my real estate investment friends. Now, while I load up this presentation real quick, I'm just going to check the presentation and make sure that we have what we need. All right, we are ready to go, guys. Here we go. So, real estate crash study, comparing then to now and then some. Well, there was the study done by the Fed, and this is basically the outcome of that study. And it's got some interesting factors. In the 1920s, the bonds that secured real estate, and we're talking comparing CRE, the real estate bonds, to like MBS mortgage-backed securities of today. They were called different things, similar vehicles, different but similar. So in the 1920s, the way that real estate was financed in the general market was more by the public. You had more individuals investing in it. Whereas now, in our current time period, it's more mortgage-backed securities are packaged up in bigger tranches and sold to big investment houses. And you can get access to that through REITs or through various funds, but that's the big difference. Real estate back then was more financed by individuals. Real estate now, paper, is more financed by big finance houses, which eventually works its way to individuals, but also by other institutions. Loan to value ratios and quality of underwriting are not as different as people may think. One of the things that people tell me all the time is underwriting is so much better. Well, not really. The factors that the Federal Reserve Bank of New York looked at in the study show that, yeah, there's some differences, not as big as you think. So if you're counting on the fact that you think that this real estate paper market is more stable than the one in the 1920s and 30s, you're wrong by the best research study I could find. There are slight differences, but they may surprise you when we get into it. In the 1920s, there was less overall oversight from a regulatory perspective. However, despite that, the quality of loans being made during the boom in the 20s was about the same from an investor perspective as what we saw leading up to the 2008-2009 crash. Slight differences, but overall not huge as you may think. The crash following the 1920s economic boom was marked by pretty hard real estate losses, in bold, reflected mainly of macro conditions than underwriting and credit standards. I want to say that again. The crash following the 1920s economic boom, and we're talking about the real estate crash, was marked by pretty hard real estate losses reflective mainly of macro conditions more than underwriting and credit standards of the time. Okay, don't assume that we're dealing with a market 90 to 100 years later, all the underlying factors are better. They're not. It's about the same. And I put this a second time. I put a second bullet point, say it again. The real estate losses we'll see in the next crash will largely depend on how bad the macro story is based on previous research. Properties with higher cash flows and lower loan to value numbers fared much better, as you would expect. So if you're doing an apartment building and you're at 65% loan to value, you have less risk of losing in a crash than somebody who took 80% loan to value. Why? Because you owe less. And the better the cash flow that you got on it, you maximize your rent versus the utility that the tenants got. The more cash flow you had, the lower level of default that you had on the real estate itself. Makes total sense. So if you're going to be a real estate investor right now and you're investing in stuff right now before, you know, the crash that I think is coming in the economy, then you want to just focus on loan to value ratios and cash flow. You're safe if you get lower loan to value ratios and cash flow, or safer, relatively speaking, based on the research. If you're doing really high loan to value ratios right now, thinking the gravy train is going to go forever, and you're not cash flowing as much because of that debt, and you're aggressively throwing money into upgrading your property and you're not managing that, you could suffer bigger losses. And you may not, that may not be a good deal for you. Properties with higher cash flows and lower loan to value numbers fair. We got that one. Loans made during the Euphoria stage. The last 3 to 4 years of that real estate market before it crashed is, I call the Euphoria stage. Every single case in which we've seen that, the losses have been worse. Why? Because you have things like ninja loans. You have things like loosening credit standards, pressure on appraisals to come higher and higher, even though it's not supported by comparables for the appraisers that are determining values, that type of thing. So that makes a lot of sense. As those things are loosened toward the end to try to keep that money flowing and that market growing, you have higher losses in that paper, which was written with the lower standards. Again, common sense. So probably the best chart in here is looking at cumulative default rates. So if you look at this chart from the Fed, the default curve was higher in the 1929 or the 1920 to 1930 originated loans than it was during 1986 crisis, the savings and loans, I believe, and then the 2006 to 2008 crisis, which was the last one. So there was a much higher peak. Now, we don't have all of the 2006 or the last recession data because this was done in 2012 and they were still collecting it, but still you can see the decline. So the 30s crash was much harder on real estate than either the 86 or the 2006 to 2009 crash. Why? What did I say on the first slide? Macro conditions. Macro conditions are worse, bigger real estate losses. So you're not guaranteed to be whole in your real estate. Why do we care as investors? Because if we have a bigger crash, it means real estate's cheaper. You may want to rotate in and buy some real estate. You may also want to consider whether buying commercial real estate now is a good deal or not, depending on the data you see here. And it may still be, you may still want to make that investment, but just look at the data, pay attention to it, use those risk factors when you're doing your new investments. All right, another neat little chart here talking about the differences between the last big crash, the Great Depression, and what we have now, the total CMBS. It's not that different other than the loans back then had more new construction. Back then we had more retail investment versus now it's more institutional and it's got a more developed bond market, although I would say probably more risky actually than this one. The loan sizes, much bigger right now than we had. People held their loans longer last time, 12 years versus 5 to 10 years now. The rate structure was fixed back then. This is fixed with some floating. Floating adds risk. I know this for a fact because I worked during a big bank during the last crash during 2008, and we saw a defunct loan portfolio from Novastar, which had high risk variable rate loans, and the defaults were much higher on that portfolio. So I've seen this from the inside during the last crash where I actually worked that data and worked to get those loans back performing. I led an engagement with 50 people to do just that. And I can speak from actual corporate experience managing that you have more adjustable rate mortgages and it's higher risk than back during the last big crash, the 20s and 30s. Just gonna say it now. So that risk factor is actually higher. Other risk factors are slightly lower. Just consider that. Other stuff is there, blah, blah, blah. But that, that's just comparing period factors of the periods. All right, moving faster. So this is total bond issuance from the last big crash. I'm comparing the Great Depression, right about 1928, right before the crash. Of course, it fell off. What does that mean? It means if you're an investor and you're wanting to get into real estate, it's harder to get the money during a crash. You really have to have your income sources lined up. You have to have investors lined up because once the crash occurs, yes, there's going to be bargains, but it's he who has the money to get the bargains, and the money's not going to flow as easily as it does prior to the crash. So you want to secure your funding ahead of time if you're thinking about sector rotating. Get your funding ahead of time and make sure that it's going to be high quality that lasts during the next big recession. Now, I wanted to compare factors between the old market, the 2031 in green, and the new one, the CMBS in blue, and the average loan term is not that different. And this is by year of issuance. So the first year of this bubble, all the way through the last year, there's a couple of little anomalies, but for the most part, the average loan term was longer during the previous crash, which means they were amortizing the costs further, which means probably you could assume, depending on interest rates, the actual payments were a bit lower on average because they had longer terms, although it depends on the structure of each one. So that's not conclusive, but it's a pretty general observation. The longer loan term you have, assuming interest rates are equal across that, you're going to have lower payments and a little bit more flexibility. So I actually think the previous period, because it had longer loan terms, probably was slightly better in terms of the payment to income ratios than we have now. We've been much more aggressive since the last real estate crash, even through today in 2022, about offering more generous loan terms, and that could come back to bite us with higher level of defaults. We'll see. The one thing that was really different about the 20s and 30s crash was the loans were concentrated in higher density populations, the cities. Now we have a little bit more widely distributed, not just from these 10 or so cities, but smaller municipalities. So there's a little bit more democracy in lending. But in terms of how that affects default rates, they didn't find in this study it really did. It's just a factor, but it wasn't one that determined default rates or losses. But I wanted to throw it in there as part of the study. Also wanted to talk about how what types of real estate were funded back then by real estate investment, the real estate paper. And you can see here 31.8% office, 19.7% apartment, 7.3% hotel. And this table is talking about the amount of loans under stress, not just the mix of loans. The average bond rate was about the same between before and now. So in other words, interest rates were about the same between the last crash and this one. So it's not as if, you know, we've had some inflation that creates more risk now, or they had more inflation back then in terms of interest rates. They were about the same. So that's not a determining factor. It wasn't the interest rate that really made the difference. Loan to value, about the same. Our loan to values are actually worse in the current real estate market than they were back then. Loan to values were lower by a factor of about 6 to 8% on average. Remember, the lower loan to value, the less risk of default. I would argue because our loan to values are 6 to 8% higher in the current real estate market, that our actual risk of default, according to this study, will be higher during the next recession. That means as an investor, higher chance of finding bargains. As an owner, higher chance of defaulting. Just know that when you're looking at your portfolio. Also wanted to compare the default rates from 1920 to 2007 based on creditworthiness. Back then in 1929 originated loans, or that loan period that ended 1929, 1930 for this study, you know, 1920 to 30, that decade, we didn't have the same ratings. We didn't have A-rated credit and C. We just threw everything together and the default rates were higher. And people say, okay, well, that proves the point. If we don't have a bad recession, default rates won't be as bad. We don't care about your study. That's not true. What this shows is if we get into another deep depression, any recent data around default rates goes out the window. Because once you get to that deep recession like we had in the 1930s, real estate will crash hard. That's what this chart shows. The default rates will go way up. Look at the percentile this is at. The default rates and the stress rates will go way up. Again, the macro is the biggest determining factor. Loan to value and cash flow determines if you default. Macro on your actual real estate, macro determines how bad it's going to be overall and how many people are likely to get affected. The worse the macro is, you have to have lower and lower loan to value ratios and cash flow on that property, or else you're going to default, in other words. So if you're a real estate investor looking at it from that angle, look at your current real estate, look at your cash flows and your loan to values, and then say, okay, if we just have a regular recession or a deep depression, I may be in trouble if we hit a depression, but I'm okay if we hit a recession. That's what that chart is good for. Defaults based on property type. 88% of the defaults were on apartments. I have a lot of apartment investors who may not know this, but 88% were apartments. Total defaulted hotels, 83, theater, various retail, other. Apartments took it the hardest. So even though people had to have a place to live, people stopped paying their rent at higher rates in apartments than in any other type of commercial real estate. So which commercial real estate would do bad during a depression? Apartments and hotels, more so than the others, even retail and office and all that kind of stuff. So, or apartment hotels. Apartments are a little bit, regular apartments a little bit lower here. But if you're into that residential area, or especially the short-term residential, it'll default worse. And then you go to retail defaults worse. And then your long-term apartments are down here at 68.7%. So depending on the mix of commercial real estate you have, you want to pay attention to that. This is based on original loan to value. So you had high default rates across the board, but if you had a loan to value lower, generally you had lower default rate. You were a little bit safer. That's for existing assets. The average duration from default to final, meaning how long it took for that to default, was higher from default to reconciliation, when it started performing again. So the amount of time it took to turn that property around, it was worse during the period in which they had the more lenient loan terms. In other words, the more lenient your loans are, the longer it takes to recover that property. So if you have a higher loan to value and less cash flow because you put more debt and maybe you refinance to put some rehab in that property, right? And you did all that stuff, it's going to take you longer to recover. So again, you want more equity in the property and more cash flow when the crash comes, and you'll survive it. And when you're looking at properties after the crash comes, you want to maximize the amount of equity you have at the beginning. You want a lowest loan to value ratio, and you want to maximize your cash flow when you're looking to pick up new properties. Okay, that's something when you rotate out of gold and silver, that's something that you want to pay attention to. And resolution type. So a lot of it had to do with capital structuring. That's how you structure the deal on real estate to make sure the numbers work and you don't default on the mortgage. The loan structure, liquidation, sales, all that. So some of it's going to go to sales. Some of it you're going to reorganize a loan. Some you're going to organize the capital structuring around the actual, like the MBS or whatever it is, the capital structuring around that paper. And then by property type, weighted average full loss. Highest was apartment hotels, followed by apartments. When you look at the weighted average of losses and the amount, apartment hotels and apartments were the worst, and then hotel, retail, industrial, so on. Mixed use tend to do pretty well. So if you're in a current mixed use with some apartments, some retail, some commercial, you'll probably do better. Another thing to consider about what you may want to buy or what you already hold. And again, the higher the loan to value ratio, the higher the actual defaults. And another thing to consider, going back to the macro, we have worse employment levels during the last two crashes, specifically the 1930, 1960 is highlighted in blue, but also the 1987, 2011 period where you had a real estate crash there. Also, the index of real GDP level is lower in green here than it was during this previous two periods. So what does that mean? Well, according to the Fed, we have worse macro conditions than we had during the last big crash. So even if we don't quite get to depression level status, it could be worse than, say, 2008, 2009, because we're worsening economic conditions as an economy than we were during the last two crashes. So I would expect some factor multiple of how bad real estate stocks and bonds will get, okay, during the next crash, because the macro is worse than it was during the last two crashes. So it'll be even worse this time, even if we don't go full depression. That's the point about that one. All right, that ends that presentation. I'm going to stop the share. That was a really long presentation for you guys. I'm going to hop over real quick to the stream. Looks like the stream is going well. Dumb Money Media, thank you for jumping on with the contribution. Your question is, day trading, health, and school eating my time, but I'll be back in the saddle soon. He's doing a new video. Thank you, Dumb Money Media, for doing that. He always advertises on my channel. He does a video. He does meme videos in the metal space. Go look for Dumb Money Media, and you can click on his name or do a search, and you can find that. Thank you, Dumb Money Media. Going back to the poll real quick, I always read out the poll. How are we doing? The question was, as an investor, do you always hold gold and silver and never rotate into other assets? Do you rotate in new assets, or you don't invest at all because it's too risky? Only one person voted don't invest, it's too risky. 51% say rotate when the time comes. Don't stay all gold and silver forever. Buy what's cheap. That's cycle rotating. That's how you make money as an investor. And 48% say gold, silver forever. I certainly understand the sentiment. Thank you for the 150 votes. We're going to go ahead and end that poll. Thank you, Peter Frohwein, for being here riding shotgun. Thank you, 𝙎𝙊𝙇𝙍 from Arcadia Economics, for being our guest and very enthusiastic guest. Thank you, everybody, for joining. Too many names here to read. What is the gold and silver trade that will break records? Here's my view. Here's my thesis. And I showed you beginning presentation. I've been right so far, but here's where you're going to make your money. How right am I going to be? Is the next one just a regular recession? Is it depression? I think depression is what I've been saying since I wrote the book in 2009. The fundamentals have actually gotten worse in the economy. I'm not backing off of that. I think we hit another Great Depression type era, for 5, 6, 7, 8, 9 years. Given that, and given what I just showed you, one of the best trades will be how high gold and silver is going to get to how cheap real estate is going to get. I think this could be one of the buys of our lifetime, certainly of my generation. This is my hypothesis. Again, disclaimer, I'm not your financial advisor. I'm not licensed. I'm not telling you what to do. Don't trade off of my advice or what I say. Please do your own research. Consult your financial advisor. Okay. That being said, what I'm doing is I'm going to hold the gold and silver. I'm prospecting real estate right now. I may buy some real estate before the big crash. More than likely, I'm going to see how bad the crash is. And then using the data I just showed you, I'm going to pick the specific type of buildings I want, the specific loan to values and cash flows I want, and that's where I'm going to sector rotate. And I go back into real estate. Remember, I was in real estate before. I rotated into gold and silver. I've made money off of that. The big money I think is yet to come, depending on how bad the macro gets. And then when the time comes to sell my gold and silver, you know, because myself and James of SD Bullion agree, you got to do that. You got to go somewhere else. You know, cash, stocks, bonds, commercial paper. Really, what are you going to do? I'm going to go into active real estate. And I think I may target apartments. Why? Apartments and apartment hotels, which is more short-term versions of apartments. You may call those like residence in now or something like that. Something that blurs the line between an apartment and a long-term hotel stay. Those will crash the most in that scenario in terms of valuations. And I'm going to go full in on that. I've already identified that. That's what I'm going to do. And that's going to be a huge trade. Now, whether you choose real estate like I am, or whether you choose to go all cash, or whether you choose to buy stocks and bonds again, maybe the tech sector is so undervalued then that you go back in, right? I know it's hard to imagine now, but it could happen. Maybe you go Bitcoin and the cryptos, you know, whatever the case may be. The key thing to know is how great is that investment going to be? What sector do you want to get in? I have so much data on real estate and I have experience in real estate. That's where I'm going. I may go into other things as well, but I think that's going to be a trade that breaks records. Why? Think about currency reset, gold and silver being revalued, depression, I think that is coming, that I wrote about in 2009 and have talked about since. Big, maybe the biggest bump in percentage terms of gold and silver, start to end, than we've seen in any other market, at the same time that real estate, especially commercial real estate, especially residential, is going to crash more probably than we've seen since the 1930s. And oh, by the way, it took more than a decade for that crash in the 30s, that real estate crash, to work itself back to even. So you not only can you rotate in commercial real estate, you can do it for about a decade and find really good deals, maybe even 15 to 20 years. And there will be demand. People have to live somewhere. So that's my great trade, the trade that I think will break records. It's a simple one. Again, do your own research. I'm not your financial advisor, but I think that's a way that you can, when it's finally time to get out of gold and silver, a place that you can go. And the reason I do that is because one of the most asked questions is, Rob, we get gold and silver. We know why to be in. When do we get out? What do we do? How do we do it? That's what I'm going to do. I'm going to rotate in a different sector. Now, if you want to do undervalued value stocks and do Benjamin Graham model, Warren Buffett, I'm cool there. If you want to go buy a bunch of muni bonds and commercial paper and you think that's safe, you can do that, whatever your chosen investment is. But do the same research I did here. Know what happens during times of great stress. Know what happens during a regular recession like we had last time and the Great Depression. Do your various levels. Do your research, and so you know what to sector rotate into. For me, it's commercial real estate. I'm done. I already know where I'm going, but I want to share that potential trade with you guys. It's something to think about for your portfolio. And again, you may not want to hold gold, silver forever. The gold you may hold forever and you know, transfer it to your kids through your will, and that's fine if that's what you want to do. If you're thinking about doing that, stay tuned to this Saturday. I'm going to have Independence Money on. These guys are tax professionals and real estate professionals. And on Saturday, we talk about the new Biden Build Back Better, whatever legislation they're calling it, that they are passing in Congress. We look at the differences in taxes on all assets. That's this Saturday on the channel. This Saturday on the channel, we're going to talk taxes. We're going to talk turkey about what's coming with the new bill, how that's going to change taxes. And that's an estate planning tool that you guys should use. It could save you hundreds of thousands of dollars or millions, depending on how much you've got invested. Watch that video. Independence Money will also be with me in Spokane at Silver Symposium this coming Monday and Tuesday of next week. 7 days from now, I'll be speaking, they'll be speaking, and their presentation in Spokane, Washington at Silver Symposium put on by Stock Pulse is going to be about how to structure your gold and silver when this new legislation comes through. If you can at all make it, taxes are one of the biggest eroders of wealth in history. The tax changes will affect gold and silver precipitously. We talk about that a little bit in the video this Saturday on my channel, but you're going to get the full version from Independence Money, these tax experts, on next week at the symposium. And we'll cover that. We'll come back to the channel probably that next Thursday or Friday next week, and we'll talk about the symposium and we'll talk about what we learned. And that'll be one of the things. But if you can get there, it'll be better. You get the whole presentation. But we're going to cover taxes for you. It's not just macroeconomics. It's not just owning the gold and silver. You got to look at your exit strategy. You got to know taxes when you get out. You also got to identify the investment vehicle you want when you get out. This program covered both. Saturday, we'll go more into the taxes piece in greater detail. And if you can all get out to Spokane, Washington next week to see me and Independence Money, they'll go in even detailed treatment over taxes specifically related to precious metals, which we love, at Silver Symposium next Tuesday, Wednesday. So if you can all make that reminder, if you're interested in gold and silver, you see the commercial we put together on every video, except for lives. So on lives, I like to talk about it live. We have a partnership with 𝙎𝙊𝙊𝙍 run by Ian. He's been on the program many times. He may be on again this week. We'll see if he can make it. He has the cheapest, lowest premium silver and gold for sale across the market, usually because he just searches for those deals and that's all he sells. He doesn't carry any other inventory. He doesn't have a big warehouse. He simply finds it cheaper, sends it to you, bypasses about 3 steps along the way, all these middlemen, and gets you cheaper. So if you're interested, go to our website, goldsilverpros.com. Click on the precious metals deals link, fill out that form. Ian will contact you. That helps the channel. Thank you, Dumb Money Media, for the contribution. Thank you for all that have purchased metal through 𝙎𝙊𝙊𝙍 to help the channel. Thank you, everybody, for being here and sticking with me. This has been, wow, 45-minute presentation day. We spent some time on this, but it's important. 2 things. 1, know how to sector rotate. Know what to do when you need to sell your gold and silver. Identify your next asset. Have that lined up ahead of time. Okay, so you can make money on this. It's not good enough just to hold gold and silver and frantically run around what to buy them with it when the time comes. We got to know our exit strategy. And also Saturday, tune in because we'll talk about your tax exit strategy, which is also important. Knowing when you sell, how to tax structure it, and knowing what investment to get into. Again, I brought that to the channel because people ask me this all the time. We know about gold and silver, Rob. What do we do during the crash? This is one of those videos to kind of help you think about an investment vehicle that you may want to consider when it's time to get out of gold and silver and sector rotate. And as we get closer to that crash, I'll do more of these strategy videos and I'll bring on more experts so we can talk about that stuff, because you guys are going to want to know what to do and when we're going to cover it. So stay tuned to the channel for that as we get closer and deeper into the crash. And it looks like gold and silver are reaching their euphoria stage. And we're like, okay, we want to buy something with it. We'll get more into what do you buy? What looks good? But I wanted to preview it here now because it's an important topic. All right. Thank you, everybody, for joining the channel. Thank you, everybody, for being on. Thank you, Yara, for guest starring with us from Arcade Economics. Peter, again, for moderating. Thank you, everybody, for being here. Till next time, Rob Kientz, Gold Silver Pro. We'll see you tomorrow. Oh, video tomorrow. Special video tomorrow, Wednesday. Mining stock. Big news from a company we cover. You're going to want to see it if you're a shareholder. Trust me. And then Thursday, we're going to have a roundtable. Saturday, the tax video. Next week, I'll be at Silver Symposium covering that. Chock full of content, all free. Just come back to the channel. You'll get it because, you know, that's what we do. Till next time, Rob Kientz, Gold Silver Pros.